Hello there, Phil Kewen here, and thanks for joining us today for our latest in our webinar series. I'm really looking forward to this one. Well, we continue to manage through the chaos of COVID-19, and we have seen unprecedented, and yes, that word has been used a lot, but we have seen unprecedented and catastrophic impacts to economies here and globally. I don't think we've seen the last of it yet. During this, I know you're having many conversations with clients and reassuring them of the strategies you have in place to ride this out, but it's always important to get the word from the experts. So what we do know is that every market collapse, every recession comes to an end, and the COVID-19 crisis is likely to be no different. But what will be the short and long-term impacts here and globally, and what sectors will be hit worse than others? To provide an economic perspective and plot the way forward in terms of how economies will emerge and what this means for investment strategies, we've partnered with SunSuper to bring you today's webinar, presented by one of the industry's leading economists, Brian Parker, who's the Chief Economist at SunSuper. A big thank you to SunSuper for bringing Brian here today. Prior to joining SunSuper, Brian's worked for a number of economics and asset allocation roles through Rothschilds, JP Morgan, Citigroup, MLC, and of course a stint at the Reserve Bank of Australia, in a career spanning over 25 years. Has an honours degree in economics at the University of Queensland, where he's also taught macroeconomics and is a chartered financial analyst. So he's extremely well qualified to talk to us today and does that regularly on the ABC as well. Now, before I hand over to Brian, just a few housekeeping issues. Today's webinar will give you one CPD hour, and we'll send the certificate out to you within the next week. Brian will answer questions. Your questions will be answered, but we'll do that at the end. Now, if I could ask you, at the bottom of your Zoom, you can see the Q&A function there. Please use the Q&A function, not chat function, the Q&A function, and I'll be reading out those questions for Brian to answer at the end. Really looking forward to this presentation. I know it'll be very informative. As always, we welcome your feedback. If you want to give us any feedback on this, email us at info@afa.asn.au. It's info@afa.asn.au. So without further ado, it's my pleasure to welcome Brian. Brian, thank you so much for joining us today.
Thanks, Phil. It's a great pleasure. And thanks very much to the AFA for the opportunity to speak. What I'm going to do is hopefully leave plenty of time for questions at the end. But before we do that, usual word from our sponsors, general advice only, etc. Let me just go through the sort of main messages as we're seeing it. And needless to say, given the state of the world, the uncertainty around anyone's projections or anyone's forecast for what's going to happen over the coming months to years is even wider than normal. But let me start by talking about the global economy. Firstly, it is beyond doubt that the first half of 2020 is going to see certainly the steepest downturn in global economic activity that we've seen in any of our lifetimes, at least the steepest economic activity, decline in activity that we've seen in the post-war period. If there's one piece of good news to all of this, there's not much, and that is that at least the world economy going into this particular crisis, the underlying fundamentals of the economy were actually not too bad. And that does provide us with a level of resilience that perhaps we wouldn't have had otherwise. The other thing I thought it worth pointing out, the recovery when it happens, and I did use the term when, the recovery when it happens is not just going to be very gradual and very drawn out, but it's going to be very, very uneven. But when we describe recoveries, and it's become quite fashionable to use letters of the alphabet, are we going to have a V shape, a W shape, an L shape, a U shape, or whatever? The answer to that question really depends on which country you're in, which region you're in, which industry you're in. It's going to be very, very, very uneven across the board. So it's going to be almost impossible to make generalizations about the shape of the recovery when it happens. The other piece of good news, the policy response has been, I think, suitably aggressive. That we have seen certainly the world's central banks step up and do all that they can do. But this is the kind of crisis where monetary policy definitely takes a back seat to get to the role of government. The piece of good news is that governments, by and large, have stepped up, that the fiscal policy response has been very, very sizable and very aggressive, with one caveat. or should I say two caveats. Firstly, the implementation of those measures is going to vary across countries, and it's becoming clear that some countries are doing it better than others. More on that shortly. And also the other caveat is that we suspect that governments will still need to do more, that especially as the recovery phase takes hold, it's going to be quite clear that we're not going to see unemployment rates fall back to where they were in January or December. That's not going to happen quickly, and there is going to be pressure on governments to do more what I would call traditional fiscal stimulus in the form of, say, infrastructure spending and tax cuts, but particularly I think infrastructure spending and things like that are going to be even more important. Now, here in Australia, again, we already had our challenges with the impact of the bushfires earlier in the year, but COVID-19 is having a vastly greater impact on the economy, and it was even before the shutdowns were put in place in things like hospitality and retail. We will have a very, very deep recession in the first half of 2020. We will see double-digit unemployment rates. We are likely to see unemployment rates at their highest that we've seen since the Great Depression. Back in the early 90s, the late 80s, we did see double-digit unemployment rates in our previous two recessions, which were a very long time ago, but we are probably going to exceed those peaks. Not by much, but I think we will exceed those peaks. Just as with the rest of the world, we will have a recovery, but it is going to be patchy. It is going to be quite gradual. I don't think we snap back. At least we don't snap back in an overall economic sense. I suspect the government does have more work to do. They certainly seem reluctant to do more, but I suspect that governments will actually have to play a greater part than they're currently planning in helping to drive recovery. I made a comment before about implementation. While the amounts of money the government have put to work in terms of supporting households, the amounts of money I think have been appropriate. But if I think about the speed with which money is getting out there, that is something I do worry about, that I don't think money is actually hitting people's pockets fast enough. Now, in terms of markets, what does this all mean for investment strategy? Firstly, crises inevitably create opportunities, and this crisis is no different. Prior to the crisis, I think it was very, very difficult to argue that share markets were cheap. I think it's very difficult to argue, or at least not in an absolute sense. Those of you who heard me speak in the last year or two would know that I often say that, yes, shares are cheap relative to bonds, but bonds look terrible. Well, now bonds look even worse. That the future returns of fixed income are likely to be terrible on a 3 to 5 year view. And so in that kind of environment, especially given the weakness we've seen in share markets, shares look exceedingly attractive relative to fixed income and cash and term deposits. The other thing I think it's worth bearing in mind is that I don't think this is the time to be too cute about trying to manage people's portfolios at an individual level here is going to be very, very challenging. It always is challenging, but I think that now is the time to be very, very cautious about doing that. We do need to be a bit selective about the opportunities we take. We need to make sure that we've got enough dry powder to take advantage of opportunities when they present themselves, and that's exactly what we've been doing, for example, at SunSuper. But can we be sure that have we seen the bottom in share markets? I think we have, but I can't rule out revisiting those bottoms before we eventually see a more sustained recovery, because I do think that there are more hurdles the world needs to overcome. Now, let's just talk a bit about COVID-19 in some perspective, if I may. The interesting thing from an economist perspective, we actually don't have a really good historical precedent to turn to in terms of analysing what the impact is going to be. This is not the early 90s recession. This is not the GFC. It's not the Asian crisis. It doesn't resemble any recession that we've seen in our lifetimes. It's not even the Great Depression. If we wanted to actually turn back to an episode historically that might give us some guidance, we really need to look back to Spanish flu in the aftermath of World War I. Hopefully not in terms of the quantum of fatalities, but in terms of its economic impact and the way it plays out. The bad news, though, is that we don't have any reliable data. And in fact, if we look back at some of the academic studies that have been done over many, many years, trying to quantify the economic impact of Spanish flu, they end up resorting to things like reading newspaper headlines and reading news stories to try and work out, which businesses suffered the most and what sort of decline in activity they experienced, because we just don't have the data from those periods. It's certainly not for the major economies. There were no unemployment rates or GDP figures that we could point to. COVID-19 so far has taken more than 200,000 lives. We sadly expect many, many more. This is not a crisis in terms of, if you look at the infection rates, et cetera, COVID-19 is going to be with us for some time, and it's going to be with us sometime after we get infection rates under control. I think that, the risk of this being an ongoing source of uncertainty for the economy and for markets over some more months post-recovery is very, very real. The other thing I think is really interesting about this particular crisis is just the speed with which it impacted both markets and economies. And this is very much not like a typical recession or a typical financial crisis. Now, what I've done on this chart, this is just an index it's a risk appetite index, and many people prepare these. So all I've done to build this chart is to look at the performance of things like high yield bonds relative to treasuries. Look at things like the Australian dollar, which tends to be a good barometer of global risk appetite. Look at the performance of, in the United States, high beta or high volatility stocks against low beta or more defensive stocks. So in other words, looking at a range of financial market risk indicators and look at how they behave relative to longer term moving averages. And what's interesting from this chart is just the speed with which financial market sentiment collapsed in the early months of this year. We have seen a fairly sharp rebound as well, which is welcome, but again, let's keep it an open question as to how sustainable that is. But certainly the speed of the decline and indeed the depth of the decline in risk sentiment exceeds that of the GFC. So it's been absolutely dire. As always, financial markets are more forward-looking than most economists or most journalists or most politicians, and they did give us some guide as to what was ultimately going to happen in the economic data. And so if I look at some of the more timely economic numbers coming out of the major economies, the picture is about as dire as financial markets have thought. So this chart just shows you the official purchasing managers indices, so the measures of business conditions in China, both for manufacturing and for non-manufacturing. And what it shows you is the speed of the collapse and the depth of the collapse exceeds that of the GFC in China. Now, since then, have we seen a rebound? Yes, we have. But the way to read these charts, 50 is meant to be neutral. So what these numbers tell you is activity better or worse than last month? So below 50 means this month we've shrunk compared to last month. So what did we see? We saw a really, really big fall. Now we've seen this number pop up to above 50. All that just means is that we've started to grow again, but we are a long, long way from catching up to what you might call more normal levels of economic activity in China. There is, the recovery even in China is going to be more drawn out and gradual. China was the first to really feel this in an economic sense, but if I look at the next slide, this just shows you some of these purchasing managers indices for the world, for the emerging markets and developed markets as a group, but also looking at the industry composition. And once again, we have seen a similar collapse, but that said, that collapse is only partially rebounded. Global economic activity is still shrinking, according to the survey, and the latest data is April. So conditions are still really rather dire. If I turn to Australia, this chart just shows you consumer confidence and business confidence using the ANZ Roy Morgan weekly index, because getting weekly data is kind of nice right now, and the NAB business confidence survey on the right. Again, the collapse we've seen in confidence it's about as bad as we feared, entirely predictable, and so really no great surprise, but it is absolutely dire. We are also likely to see over the coming months some really dire labour force numbers in Australia. We'll get labour force data, or official monthly data, very shortly, I think in the next 24 hours. But to give you a guide as to how bad that's going to be, this chart may be somewhat instructive. The light blue line on this chart is just the official unemployment rate, standing at just above 5. The dark blue line is the ratio of ANZ job ads relative to the size of the labour force. Now, I've taken the ANZ job ads figure that was released earlier this week and used, even though that's an April figure, I've used the March figure for labour force, just to give you a guide of the magnitudes involved here. So what we've seen in April is the number of job ads literally halve. In fact, more than half, down by about 53% in the month. That is dire. And just taking it at face value, it's consistent with a very, very sharp spike in the unemployment rate during the month of April. And as I said, we'll get the official data on that very, very shortly. And that is not going to be the end of it. You will see further flow-on effects and further increases in the unemployment rate. The Reserve Bank is still clearly expecting a double-digit unemployment rate, and that is a perfectly reasonable expectation to have, given what is happening in the underlying labour market. Now, I mentioned that the recovery, when it happens, and I stress when it happens, is going to be very, very uneven. And what I've done is just to look at a range of factors. There's been some quite interesting work done by some of the researchers out there about, what will determine success, which economies are faring better or likely to fare better than others. And there's a range of factors which I think will help determine this. Firstly, the macro policy response. The faster and the larger the policy response, the more effective is the implementation of that response, the better the recovery will be. More on that shortly. The depth of the decline in GDP, and there's not a lot of science to this. It's almost like, the further down you go, the more likely you are to get a bit of a bounce. So the bigger the decline in employment and in spending and in output, the more likely you are to see some pent-up demand start to accumulate, especially if governments can make sure that people have spending power for the recovery or spending power for when things open up. So, if you have a greater level of pent-up demand, then all other things being equal, you should see a better recovery. Third factor, infection control success and the risk of resurgence. A lot of people talking about the fact that, yes, the shutdowns that we've seen are causing a great deal of economic stress, absolutely. And there's this idea that we need to reopen things fast, because if we reopen things faster, people can get back to work and that'll improve confidence. Well, that's fine, but that is only part of the story. If you risk a widespread resurgence in infection rates, you may end up doing more damage to people's confidence. And certainly, this idea that you slam on the brakes, then you take the brakes off, then you've got to slam on the brakes again and then take them off later. That is no way to drive a car, and it's no way to run an economy. And it's certainly no way to run a policy response to a pandemic. So infection control and success is going to be really crucial. And it's become pretty clear that some governments clearly got it right. There has been no one magical recipe for success, but it's pretty clear that, for example, the Taiwanese and to a large extent the Koreans have got it right. Doesn't mean their economies are immune, because these are still very open economies, still very vulnerable to downturns in exports, and they are feeling it. But it does mean that their domestic economies can hold together a lot better and not have to suffer the same sort of disruption. Why? Because they got in and started testing everybody they could find and really try and get the things under control quickly. Trade linkages are going to be crucial. Again, all other things being equal, the more heavily your trade is exposed to the worst impacted economies, the worse off you're going to be. It works in reverse as well. Labour market flexibility. How fast you got rid of people, how fast you got people into isolation and out of work, but also more importantly, how fast you can get them back into work will also determine the strength of recovery. Financial stability. Now, I mentioned in the introduction that one of the things in our favour is that the world economy was not doing too badly, that the underlying fundamentals were looking okay going into this. And a big part of that story, in my view, is financial stability, and in particular, the health or relative health of banking systems, with a few obvious exceptions, but generally speaking, banking systems are in reasonable health. What it means is that to the extent that governments are using banking systems as an outlet for largesse, as an outlet for support, those banking systems are better placed to provide that than they would have otherwise. Okay, so financial stability is fairly crucial. And finally, exposure to higher risk industries. And this is where Australia, believe it or not, may be actually relatively well protected. To the extent that we are very heavily exposed to, or more heavily exposed to primary industries, mining and agriculture, but particularly mining, and less exposed to industries such as manufacturing, the better protected we are. So again, the industry composition of your economy will also help determine just how dire the downturn will be, but also how strong the recovery will be. Another example is obviously airlines. To the extent that your economy is tourism dependent, is travel dependent, you are going to struggle in the recovery, because it's going to take some time before we see anything like normality in terms of tourism and particularly in air travel, for fairly obvious reasons. And I note Warren Buffett's comments the other day that he's basically triggered a stop loss effectively. He sold out of his US airline exposure, basically taking the view that the airline model is so uncertain, is going to be structurally so different, that he decided to cut out, which I thought was interesting, given that he's also been quoted in the past as saying that when the Wright brothers were flying at Kitty Hawk, when they first took to the air, that somebody should have been there to shoot them down, because they would have saved airline shareholders trillions of dollars over the following century, just as an aside. So let's just explore some of these. I mentioned that policy is crucial, and it is, and governments are mostly stepping up. And what I've done here, this just shows you how strong the fiscal policy response has been relative to GDP, relative to the size of your economy. And so Australia and the United States really do look very good on this. And certainly just the dollars involved have been very, very substantial, over 10% or nearly 11% of GDP in the case of Australia. My concern is the money going out fast enough. And I think that's a problem, okay? Other countries, I think, will clearly have more to do, but certainly Australia, the United States, the UK, Germany, I'm surprised at. If you were ever going to trigger a national emergency to justify sacrificing your fiscal rectitude, now is the time, and Germany have done that, and that's entirely appropriate. So governments are stepping up, but I do fear that more will be needed in the recovery phase. The other piece of good news is it's the detail. Not so much in implementation, but in the detail of the measures that have involved. And what I've done here, just as just some numbers from UBS, where they looked at the detail of what governments have announced. Fiscal policy, traditionally, if you get a traditional recession, what do? You cut taxes and you start spending money on things like roads and infrastructure. You get people back to work doing stuff. This time around, it's not been about that. This time around, it's been much more about how do we support businesses, how do we support households. And I hate using these catchphrases, but hibernation is a good catchphrase to use, because I think it's an appropriate analogy. How do you put the economy into hibernation and ensure that as many businesses and as many households come out of this in as good a shape as possible when the recovery eventually gets underway? And so in that sense, the world has been very much focused on doing the right thing, putting money into people's pockets, helping out businesses, helping with measures like job retention, wage subsidies, etc. In Australia, that's been even more so. The lion's share of the fiscal response has been JobKeeper. Now, my concern is the coverage and the speed with which this has been ramped out. I'm also concerned about the fact that it's a reimbursement scheme. So you're asking businesses to pay people out of cash flow, which doesn't exist, or cash reserves, which may not exist, or to go into the friendly, welcoming arms of their local commercial bank, borrow the money to pay their people, and then get reimbursed a week or two down the track if they qualify. I'm worried that that is too many hurdles. It would have been better to actually get money into people's pockets faster. But nevertheless, a lot of people are going to be kept in work and are going to have their income supported by this measure. The other factor is sort of higher risk industries I mentioned, so how exposed you are to relatively high risk industries. So by high risk industries, I'm meaning things like manufacturing, accommodation and food services, retail, tourism, obviously. Okay. To the extent that Australia is the bottom of this list, it's because we actually have a relatively high share in things like mining, in terms of our share of GDP and share of employment. So Australia is actually somewhat less exposed to these higher risk industries than the average of the 15 countries I've shown here. Countries like Taiwan, Germany, Korea, these are export and manufacturing export powerhouses. And to the extent that they are exposed there, they are relatively higher risk. So in a policy sense and in terms of industry composition, Australia actually does stack up relatively well. Now, the other thing I want to talk about just in terms of investment strategy, and forgive me, this is a bit SunSuper specific, but it does have general application. A lot of conversation in the press about unlisted assets and the challenges of keeping super funds liquid and meeting member demands for switching and meeting member demands for early release, especially after the government's measures to allow people to relax those criteria and to allow people to access a portion of their retirement savings if they're feeling financial stress. A few things. Firstly, the unlisted assets that we hold and other major super funds hold are not immune to this downturn. These assets, when you have such a major downturn in share markets and you have the worst global recession in decades, I'm not going to front up on a webinar like this and say, oh, but don't worry, our infrastructure assets are just fine. Our private equity portfolio is just fine. No, it's not. It does hold up better than listed markets, but it is not immune to a major downturn. Have unit prices been adjusted? Have valuations been adjusted? Yes, they have. There is considerable doubt about whether every super fund has adjusted their valuations at exactly the same time. I think some funds have yet to fully reflect what's happened in the value of their assets. That is inevitable though. Other funds have moved early. For example, we moved early. We actually moved the valuation of our unlisted assets down during the March quarter. But I think the GFC experience is somewhat instructive. So what I've just shown here, and again, this is just SunSuper's experience, but it also applies, I think, more generally. During the GFC, how bad did things get? And by the way, the timing varies depending on which asset class you look at. So I have adjusted for that. So I'm not gilding the lily here. What it shows you is that while even during the GFC, while unlisted assets were not immune, they did do a better job of protecting capital than listed markets. And we don't have any reason to expect that the current episode would be any different. Now, let me just go through these main messages again, and we'll hopefully throw it open to questions. We are in the midst of the worst global recession in any of our lifetimes. The policy response, I think, has been incredibly helpful, although far from perfect in some cases. Do have concerns about the implementation, but make no mistake, what the measures that have been put in place by governments and central banks will help the world economy through this hibernation phase and help underwrite the recovery. But that recovery will be patchy, it'll be very uneven and subject to a very, very high level of uncertainty. Here in Australia, a similar picture. We are seeing a very, very deep recession. We do believe the government probably has a bit more work to do, but Australia, in a policy sense and in terms of a whole bunch of other factors, is relatively well placed, we think. In terms of markets and strategy, crises create opportunity. Share markets are considerably more attractive than they were several months ago, the risk of stating the bleeding obvious. Have we been buying? Yes, we have, in a very careful and very risk-controlled way early in the piece. In the last few weeks, taking some profits on that. Just reducing exposure a tiny bit because we have seen a very sharp rebound in share markets over recent weeks. For any superannuation fund, this episode right now is about managing liquidity requirements, while also making sure that your portfolios are in balance, that they remain true to label, and that you still have enough dry powder to capture opportunities that come your way. And make no mistake, every crisis, and to take Phil's comment at the start, every crisis, every bear market, every recession, every downturn comes to an end, bar none. This one will be no different. But every crisis also throws up opportunities, and this one will be no different. But if you are going to try and manage people's money by trying to predict exactly the timing of when these markets are going to recover, or which economies are going to fare best, or which industries are going to fare best, that I think is going to be next to impossible. And with that, I'll thank you again for your time. Thanks to the AFA for the opportunity to speak, and hopefully we've got plenty of time for questions, and I think we do. That's a personal best for me. I've actually stayed under time. Phil, I'll hand over to you.
Thanks, Brian. And yes, we do have some questions. So I'll kick off with the first one from Cara Williams. There's already some concern about ageing population and the pressure on younger generations. How do you foresee the burden of repayment from the COVID debt impacting younger generations?
Oh, that's a really, really good question. And it's certainly, and to be honest, it's something I probably should have addressed in the presentation. So Carol, I really appreciate the question. Lot of concern about the debt burden, especially, you know, we are likely to see a significant increase in public debt levels across the globe as a result of what governments have had to do. But I'd say several things. Firstly, what are bond markets telling us? Bond markets are telling us that governments are able to borrow money more cheaply than they arguably ever have. When you are at a stage where real interest rates are negative or incredibly low, and in some countries where nominal interest rates are negative, bond markets are basically saying that the funding pressure, if you like, or the risk of governments being crowded out is just not there. And so I think there is considerable scope for governments to take on the extra debt. In the case of Australia, we already had very, very low levels of public debt relative to GDP. Now, make no mistake, our copybook is going to be blotted somewhat, but relative to the size of our economy, even if we end up with 55% of GDP in terms of net debt, that is still very, very low on any global comparison. So I think the Australian government is still looking very well placed. And the other thing is, I think the best analogy historically I can think of is really post-war, that you go into large amounts of debt to help fund your way through an emergency. And given that a large part of that spending by its very nature is temporary. And so you do tend to see kind of an automatic recovery in your budget position, especially as the economy returns to growth. And so I think even though we are likely to see debt levels rise significantly, growth does actually solve a big part of the problem. It certainly did in that post-war period. And again, I might be overstating it, but in terms of a global emergency, I'm not saying this is like World War II or World War I, but the historical analogy, it's not irrelevant, put it that way. So I'm relatively relaxed about government's ability to fund this and the world's ability to manage this exposure over time. That'd be my take on it. But one final caveat though. If we think we can get out of this without any kind of tax impact, I think we're dreaming. I think we're about to have a lesson reinforced. For too long, for many, and again, I've said this before in presentations, we have trained a generation of Australians, maybe two generations of Australians, to think that when they hear the words tax reform, what do they think? How much am I going to get back? That's not tax reform. And if we think we can actually, use this as an opportunity to reform our tax system, and if our framework is good, how can we actually tax people less? I think we're absolutely deluded. I think we'll need to do something on the revenue side to help that debt recovery over time.
So do you see that as
just a personal view?
Do you see that as like reform or just an increase in the GST, something simple like that?
I don't think an increase in the GST, but on my wish list, would be looking at things like replacing stamp duty with land tax. I think at some point, governments are going to have to look again at negative gearing. Governments of either persuasion, again, it's just my personal view, because we need to raise revenue in order to provide the services that people expect from their government. And one of the other learnings of this crisis, I believe globally, this ideological swing that we've seen towards smaller and smaller government, and this idea that the government just, is, to quote the old Reagan quote, that, the government is part of the problem. It's just not true. During a crisis, you need a strong, robust public sector to help you through a crisis. That is I think, a very powerful learning of this episode. And it's a learning most visible in the United States, where clearly the public sector, by and large, has not been up to this crisis. And that really reflects the fact that it's been starved of resources for several decades.
And do you see, what about franking credits? That seems to be back on the agenda as well.
Look, again, personal view only. It's not a SunSuper position. I think that has to be revisited. I just don't see, back when that proposal was put in place, Treasury at the time warned that while the cost of it wasn't very much up front, that as dividends grew, the cost would be enormous and it was a dumb idea as a result. They were right. But whether governments of either side had the guts to do something about that, I just don't know. I'm not saying, I'm not talking about abolishing negative gearing at all, right? I'm simply saying that extra giveaway that you get a tax credit when you already weren't paying any tax, something's going to have to be done about that. But really, that among a whole range of other things, I think have to be on the table.
Yeah, I think it's one thing that this is giving us a license, or giving the government a license to take a clean slate. I do have more questions here. So one from Sean Delaney. Do you think the government will need further stimulus this year or early next year?
I think they will. And thanks, Sean, for the question. I think it'll take more of the form of infrastructure. I think you'll actually, I think there's got to be more scope to actually help support activity through some more infrastructure work. I don't think tax cuts are going to be as efficient. The reason I say that is that I wonder whether, providing tax cuts as part of your stimulus, that might be part of the story. But it also goes to my point earlier, you need revenue. We need stuff that's going to generate growth and not results in a permanent hit to revenue. And that's why, and I also worry that tax cuts might actually end up being largely saved and not spent in this environment. I wonder whether the impact on consumer behaviour ends up being more long lasting, and that people were already cautious, at least here in Australia. Consumers were already very cautious going into this crisis. This is just going to give that more impetus, I fear. And so tax cuts may end up not providing the kind of stimulus you want. So I'm wondering whether there's more the governments could do on the infrastructure side to help drive that recovery. So that I suspect you will see something, certainly at the state level, perhaps less so at the federal level.
Okay, thank you. This one from Anonymous. In your opinion, how likely are we to retest lows experienced in March? Or have we rebounded too quickly?
That's a good question. And I always get skeptical about anonymous ones, but that's all right. Hello, and thank you, Anonymous, for your question. Look, I think we do. I think there's a real risk, and no one knows. Nobody knows. I think we do see corrections along the way. I don't think that it's off to the races here. I don't think that we're entirely out of the woods. There is significant potential for disappointment. What if we start to see, just as economies are, some states in the US looking at opening up their economies at a time when infection rates are not yet properly under control? What if you start to see infection rates start to rise in some of those states that are reopening too early, in my view? What do? Slam on the brakes again? How do markets respond to that? We've not seen, it may not matter for us in the West or for Western markets, but, I don't believe the numbers coming out of India. And we've not really seen this hit Africa properly. Sorry, that's an awful thing to say. You hit it properly, but anyway. But there's going to be a whole bunch of countries in the emerging world that are going to be hit a lot harder in the short term, I think.
Yeah.
So I don't think we're out of the woods here at all. We are in for more volatility. I do think that this will prove these levels of stock market. So the last few weeks have proven to be quite good buying levels, provided you take the view that you're never going to pick the bottom. Will share markets be significantly higher than where they are today in the next 3 to 5 years? I believe they will, absolutely. But we could be in for a wild ride still in the short term.
Yep. Thank you. And I have two questions similar from Anonymous and from Sam Pereira on your thoughts on the Australian property market or your thoughts on the housing market.
Yeah, it's a good question. I'm very skeptical. I think that, go back a bit. A few weeks ago, lots of doom and gloom assessments about, property prices will fall 20, 30%. How do you measure that given you don't have any great sales activity? How do you value an asset when there's no trade? And so, calculating what's happening to house prices is already a statistically challenging exercise, even at the best of times. But when you have such little activity, when you have relatively low volumes, what sort of, and the price information that comes out of that, how reliable is that? In my view, not very. And so that was a few weeks ago. Now we're starting to see signs that the real estate industry and government are starting to work out ways to, maybe open the industry up a bit, allow open houses under very, very tight controls and things like that, allow auctions, but basically say to people, you can only turn up if you're a registered bidder, so there's no spectators, right? That means that you might see some more renewed health come into the market. I don't think overall property markets fall that far. In the short term, as I said, it's going to be very hard to read the price information, but I also wonder that, a combination of very, 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 very low rates and the fact that unemployment rates are going to be capped out at, 10 or 11, yes. And that a lot of people are going to be on fairly healthy levels of income support. So I don't think you're going to get this. I don't think you're going to get the kind of forced selling, the kind of foreclosure selling that normally drives prices sharply lower during a recession, because I think the policy response here might just prevent a lot of that. I'm not saying that no one's going to get into trouble. I think, some people clearly will, but I think this time round, the policy response in terms of supporting people's incomes, telling the banks to basically sort of cut borrowers some slack for a few months, might actually mean that we get out of this without the kind of property market bloodbath that you typically see during a major recession. Not saying you don't, and again, you'll also get a lot of variability across the country. Some areas will perform worse than others, as is always the case. But I'm perhaps a bit more relaxed about the property market than some commentators have been, if that makes sense.
Yes, thank you. One from Valentino Ordino. Brian, asset allocations have obviously been put out of line dramatically over the last month or so. How quickly do you recommend we re-weight back to alignment?
Oh, that's a good question, and I can only speak from our point of view. For example, I'm a great believer in the rebalancing premium. That there is a return premium to be captured by not doing anything terribly clever, but just rebalancing on a regular basis. There were some very, very good rebalancing opportunities over the last few months. So I'm a fairly big fan of disciplined rebalancing. So I wouldn't, this is not the kind of environment where I would be putting all of that on hold. This volatile markets are the kind of environment where you can add a bit of meaningful value by just disciplined rebalancing. And so it's not a very complicated answer, I'm afraid, but not that's a bad thing. Simple answers are really good. But I think disciplined rebalancing is a lot to be said for it. And I don't see why that should be any different whether you're a financial advisor running model portfolios or whether you're a major super fund. That'd be my take. Pardon me.
Thank you. Question from Christine Davey. Any comment on the Buffett index being at an all-time high?
Buffett index being at an all-time high. I'm not sure. To be honest, I'm not sure what the question actually means. I
was hoping you would, because I didn't.
I was hoping. Yeah, I don't know what she means. But Christine, if you want to follow up online, we can go to another question and come back to that if you like.
I'll look down further, Christine, if you want to give a follow-up.
Yeah, please do. Sorry about that.
From Mark Bynum, global share markets usually bounce back faster and higher than Australia in the past. Any thoughts yet for this bear market?
Look, I think to the extent that the Australian market has actually held up relatively well this time around. Oh, no. The fact that we did seem for a while there to be, we did seem to be kind of holding our own at a time when international markets were struggling. It was kind of a bit short term, but the fact that the Australian economy and the policy response, I think a relative positives. I do think that we actually come out of this looking relatively good. I think that would suggest that in the short term, perhaps the Australian market ends up being, relatively well placed. But I don't have a strong view as to whether, if the question is more, do we see global markets fare better in recovery versus the Aussie market? I don't have a strong view on that. I do think that, I just think in terms of relative value, probably Australia doesn't look quite as attractive in a relative value sense as places like Europe and the emerging markets. But that doesn't tell us anything about how these markets might fare over the coming weeks to months. I think that's more of a 3 to 5 year signal. And so on a relative value basis, I think I'd prefer Europe and Japan perhaps. But as I said, I don't have any great insight as to how it fares, how we sort of fare relative to international markets in that recovery phase.
I think that's also answered Michael Barlow's question as well. Just clarity, Christine Davey again, the so-called Buffett indicator takes the combined market capitalizations of a country's publicly traded stocks and divides it by quarterly gross domestic product. Investors use it to gauge whether the stock market is overvalued or undervalued relative to the size of the economy.
That's Tobins Q. Economist speak, it's actually the Tobins Q ratio. So it's not one I track because it's not, it typically has not given, to me, I just don't think it's as reliable an indicator as perhaps the theory would suggest. And so it's also, there's a variant which is the market value over the book value of the capital stock. It also raises issues about what if you've got businesses that are relatively capital light, that don't, so they're not sort of traditional, bricks and mortar type businesses. So I don't tend to follow Tobin's Q all that quickly, all that closely at all. In fact, I haven't seen anyone kind of write about it or use it analytically for a while. Because I thought my rough figuring was when you were talking about the Buffett index, Buffett is a value investor, and I think things like longer term price earnings signal, so the cyclically adjusted PE ratio, so price divided by a 10-year average of earnings, that's now showing that probably the US looks closer to fair value than it has for some time. And relative to cash and bonds, the US markets look really cheap. But that's also because cash and bonds look terrible.
Okay, thank you. One from Deborah Cant. Brian, what's your view on the capital raising companies are doing currently?
Oh, really good question. And full disclosure, we've certainly been a participant, selectively, but certainly been a participant. I think by and large, I think companies have moved early and prudently to try and buffer their balance sheets. I think that by and large, I think it's been I think companies have actually managed this reasonably well by taking the opportunity to raise capital to so that they can ride this out in a more reliable way. But in terms of participating, there are capital raisings and there are capital raisings. What we've seen, and this is feedback from our managers, stocks that have been, really, really hot and in demand, they've been so oversubscribed that even the top tier Australian equity managers have got they might have asked for, 10 million and got 500,000, that sort of thing. So I think it's important, very important to be very selective in terms of participating in these raisings. This is not I don't think this is the kind of environment where you want to stump up for everyone. But I do think by and large, I think companies have behaved fairly prudently and sensibly here.
Valerie Lumbee touches on an interesting point, because there has been a lot of discussion around Australia's reliance on imports and move away from manufacturing and exporting. So from Valerie, do you think Australia will expand our export opportunities and recreate industries for job opportunity into the future? And some examples, hydro, solar.
Look, I think there's a big global lesson here. I don't see this, let me give a big sort of global picture, and then we'll sort of focus in more on Valerie's question about Australia in particular. I'm a fan of free trade. I'm a fan of the benefits of globalization. I'm a fan that, in the production lines globally and production facilities are now, we've seen a global productivity improvement as a result of globalization of manufacturing. So I'm by and large a fan. However, I think the lesson here is that it has gone too far. That, to the extent that you rely excessively on global supply, or in some cases rely entirely on global supply for what proves to be very, very essential items, face masks being a case in point. That does suggest that pendulum has swung too far. There needs to be some sort of recalibration. I don't think we throw the globalization baby out with the bathwater, but I do think you will see a reappraisal of just how about the reliability of global supply chains, and I think you will see global supply chains come under question. You'll see more domestic supply of a range of goods. I think you will also, to focus more in on Australia, I think that applies here as well. I also wonder, and again, I would not class myself as an expert here, but if I think about things like the progress in things like 3D printing, that the advances in production technology, that the old rules that, well, you can't make X, Y, or Z in Australia because we don't have the scale or we're not going to be as efficient. I wonder if those old rules no longer apply in some cases, and that you do start to see opportunities present themselves to do more manufacturing here in Australia. I don't think this reverses 50 years of long-term decline, but I think at the margin, you will see opportunities here. And to touch on the specific particular point about solar and wind, etc., it's long been a bugbear of mine that the long-term, you look at the long-term trend towards renewable energy is not stoppable. The economics of it are really, really compelling. And Australia should be really, really well placed to continue to increase the share of renewable energy in our power supply and use that clean energy as a source of competitive edge. I think Ross Garner has written about this, a bunch of people have written about this. It makes economic sense. It's not to say, I'm not saying that, we're not going to be doing thermal coal from tomorrow. It's not going to be the case. But it does mean that over the longer term, the demand for thermal coal relative to the demand for other sources of energy is going to decline. And I think we need to I think we need to accept that. And so Australia should be really, really well placed to do stuff in this area and use that source of cheap energy or cheap, clean energy as a competitive edge to help us do perhaps other things in manufacturing, which I think is where Valerie was heading with that question.
Yeah, yeah. And on a similar vein, in terms of the global supply chain, Ram Golamandala has asked, do you think, given the tensions with China, countries like India will play a bigger role in the future, the global supply chain?
Excellent question. And the short answer is yes. Not sure there's a long answer, but I'll make one up. I think, look, let's put aside what Trump and his acolytes are trying to do with China at the moment and saying this is all China's fault. Everything would have been fine if it wasn't for the fact that China dropped the ball or China kept things secret. Yeah, that's true. It's pretty clear that China tried to hush this up early in the piece. But we knew that because US intelligence and other intelligence services were saying that. And Trump was told that. We were all told that. So you can't turn around and say, oh, China was telling porkies, that's why we're all in trouble. No, we knew China was telling porkies and the world should have realised that and moved on. But that said, China has, in a geopolitical sense in particular, let's put the virus to one side. In a geopolitical sense, China has not behaved well for some years now. Okay? And this idea that we can continue to rely on China as some sort of low-cost, low-risk source of supply for a whole range of things, I think that is going to come under question. And I think the world is going to have to look at diversifying its sources of supply of a whole range of things. Some of that supply will come, not all of it. I mean, China will still be a global, arguably the global manufacturing centre. But over time, I think you will see global businesses look to diversify their sources of supply. And India is clearly a potential winner here, as is countries like, and we're already seeing it in countries like Vietnam, which handle this crisis really well, by the way, just quietly. But I think, but India is the only one with the potential, with the scale to really be a meaningful competitor or a meaningful alternative source of supply to China. Other countries like Vietnam, it's a country of 90 odd million people versus over 1 billion. It can't take up the slack. But I do see people looking at China as a supplier and as a partner in business. And I think this crisis has sowed seeds of doubt.
Thank you. Probably got time for one more question. Chris Harris has asked on your view of the oil crisis. Got about a minute left.
Oh, cool. I don't know how many boats are currently parked just offshore all over the world, full of oil they're waiting to unload at a vaguely reasonable price. So many, when you look at it on a satellite map, it is staggering. Look, I think oil prices here remain depressed for some time. You are seeing, and you've already seen a very, very sharp reduction in the number of US rigs in operation. The US oil industry typically responds to lower oil prices really fast, and they've certainly done that this time around. The Saudis, not so much. The Saudis are still pumping the stuff out. And given that, even at relatively low oil prices, the Saudis are still making money and they need to make the money. I do see the oil price remaining relatively depressed, I think, for some weeks to months. I think this is the sort of thing which it's going to take some time for that excess supply to be worked off. So I wouldn't see, personal view, I wouldn't see a meaningful recovery in the oil price until next year. But again, in the short term, I have no idea because the oil market is kind of hard to read. Well, like all financial markets, it's almost impossible to read in the short term. But I just think that the fundamentals favour depressed oil prices for some months to come before we see a recovery. You're certainly not going to see the kind of recovery in transport demand, particularly air transport demand, that would perhaps underwrite a stronger recovery. I think it's going to be quite slow.
Thank you for that. We are out of time. Folks, just a reminder, you will get a notification when the presentation and recording is up on the website for you to access, and you'll get sent your CPD in the next few days. Thank you for joining us, and a very special thank you to Brian and SunSuper for bringing Brian here today. Thank you very much.
Phil, thank you very much. And thanks everybody for your attention today. It's a great pleasure.
Thanks, Brian. Have a good day.